Good afternoon, everyone, and welcome to our final webinar for the 2017. My name is Alistair Dent. With me on the call today is Josh Wiggins. I'm actually filling in for Brent Rudham, another of our client directors. Brent couldn't make the session today, but no doubt you'll hear from him next year. Once again, it's great to have you all joining us today. Proving cash flow is always a popular topic among business owners. And I'll hand over now to Joshua, and he can run us through what we're covering in our session this afternoon.
Thanks very much, Alistair. So you might recall in our August webinar, we went over the fundamental principles of cash flow management, including the all-important 3F approach to cash flow. In our session today, we will be diving a little deeper into the elements that have the biggest impact on your cash flow, which is your working capital. The structure of working capital differs in almost every business, whether you're in manufacturing or merchandising or contracting. But the importance of working capital management in optimising cash flow rarely changes from one business to the next. Aside from external funding, optimising working capital is hands down the greatest opportunity a business owner has to improve their cash flow. So before we begin, a quick run through of the agenda for today's session. We'll be looking at where profits move on the balance sheet and how to unhide them, the structure of your working capital and what it means for your cash flow. We'll look at the short-term cash flow fixes versus long-term improvements. Then we're going to take a look in detail at each area of working capital, managing debtors, improving your inventory, and solving the creditor conundrum. And as always, we really value your feedback. You'll see the feedback form pop up at the completion of the session. If you fill out the form, we'll make the slides from today's webinar available to you. You can also request a copy of our cash optimisation tool. And with that, I'll hand back over to Alistair.
Thanks, Josh. Okay, so where did my profits go? Most would know the feeling. You've had a great quarter or perhaps a great year, maybe some strong growth. And profits are good, but your cash flow has never been tighter. And so this is the million-dollar question. Where did your profits go? And you just need to look at your balance sheet to find out what really happened. Possibly there was some leakage in owner's drawings or investments or maybe pay down of debt. But more than likely, a good chunk of your profits are just sitting in your working capital. Let's have a look at a simple example. You've had a good year, let's call it $1 million profit, but your cash position hasn't improved at all. So where did the cash go? Let's have a look at the working capital movement. Last year's debtors were 1.3 million, this year they're 1.85. Creditors were 800,000, this year they're 900. Inventory was at 1.2 million and it's increased to 1.6 million. So you can see the totals there. We've gone from net working capital of 1.7 million last year to 2.55 million this year. So let's look at the next slide to illustrate the movement. So we start with $1 million net profit there on the left. Add back 50,000 depreciation as a non-cash expense. But then we can see the working capital movement. We've lost 550,000 to debtors and another 400,000 to stock. And then finally we've clawed back 100,000 through the increase in creditors. And what we can see is that 850,000 has actually been sucked back into working capital. So the net operating cash flow was only $200,000, even though the profit was $1 million. Now this wouldn't normally happen, I guess, unless you're growing, but it is important to understand this point, and that is that growth costs money. And at the very least, it will cost you some of your profits. Sometimes growth can actually cost you more than your profits, which means you have to find another way to actually fund that growth. It is possible to actually grow broke. It's a term we use where a profitable growing business fails because it cannot fund its working capital growth. Now Josh is going to run us through an understanding of the working capital position.
Thanks, Alistair. Now, no doubt many on our session today understand or have a good understanding of what working capital is. In a true financial sense, working capital is your current assets less your current liabilities. But in the context understood by most small to medium business owners, working capital includes stock, debtors, and creditors. Take your stock, add your debtors, subtract your creditors, and that's your net working capital. For project businesses, your working capital may also include work in progress and income in advance. Now, to put your working capital into a cash flow context, it's very important to get your head around the concept of your cash conversion cycle. What we're talking about here is the period from when the cash leaves your bank account to when it comes back in. Logically, the longer the cycle is, the more difficult your cash flow problem becomes. Now, here on the screen, you can see the cycle of a typical business. Firstly, stock is purchased from the supplier. Then there's the window of time before payment is due. The goods will sit in the warehouse or work in progress until the sale is made to the customer and an invoice is raised. Only once payment is received from the debtor does the cash come back into the bank account. This is the cash conversion cycle. Now let's put some numbers on the cycle. In the example here, the cycle starts when you purchase stock. This is day 0. Let's say you pay for your stock on day 44. However, the goods remain in stock for a further 66 days until they're sold on day 110. You then have to wait a further 62 days for your customer to pay you on day 172. Your cash conversion cycle in this instance is 128 days. Inventory days of 110 plus debtor days of 62 less creditor days of 44. This means that you need to fund approximately 4 months of working capital. Slicing just a few days off your cycle can do wonders for your cash flow. So if you're looking to improve cash flow in your business, you must get a thorough understanding of your cash conversion cycle. So here is how you can calculate the key numbers. The debtor days calculation is very simple. Take your debtors balance, divide it by the total sales for the period, and multiply it by the number of days in the period. Inventory days or stock days is a similar calculation. Take your inventory value or stock on hand, divide it by the cost of goods sold for the period, and multiply it by the number of days in the period. And finally, creditor days, which is almost the same as the inventory days calculation. Take your creditors balance, divide it by the cost of goods sold for the period, and multiply it by the number of days in that period. So that's the cash conversion cycle in a nutshell. Alistair, you can take us through the next section.
Thanks, Josh. So when you're looking to improve the cash flow in your business, it is important to distinguish between short-term fixes and long-term structural improvements. Now, unfortunately for many businesses, cash flow becomes a priority when it becomes a problem. And really that's just to say that it doesn't get too much thought until the cash actually starts to run out. So then the problem creates a bit of a panic. Slow down on stock orders and chase debts really hard, don't pay the creditors just yet, probably ask the bank for an overdraft extension too. And that's not to say that these aren't all workable strategies. It's just that it would have been better to think about them as part of a longer term strategy rather than a short term fix for a cash flow crisis. So then if you want to consistently improve the cash flow, the cash in your business, you need to implement long-term structural improvement rather than just short-term fixes. And the most effective way to do that is to shorten your cash conversion cycle. So using some numbers from our earlier examples, let's do a few quick calculations. The current cash conversion cycle is 152 days. You can see that on the screen. That's inventory days of 140 plus debtor days of 73, less creditor days of 61. So the value of cash tied up in working capital is 2.65 million. Now let's assume for a minute we can make some improvements to each of those numbers. So let's just make a few small changes. If we improve debtor days from 73 to 65, that's just an improvement of 8 days. Inventory days from 140 down to 125, and then a small change in creditor days, say from 61 to 65. Now these are pretty small adjustments, but they actually add up to 430,000 in cash flow improvement. And if you factor in growth, this number would be even higher. So how do you free up the cash? Shorten the cycle. At the end of our session today, you can request a copy of our cash conversion cycle optimizer to run some of these calculations for your own business. Now I'll just hand back to Joshua to speak about debtors.
Thanks, Al. So no doubt you've heard it all before. It's not a sale until cash is in the bank. Good debtor management is an essential part of optimising your working capital and therefore your cash flow. How can you collect as much cash as possible as quickly as possible? There are two secrets to great debtor management. One, have a proactive policy. Two, follow it. So you must have a proactive credit management policy. Well, firstly, you must actually have a policy, which many businesses sadly don't have. So if you don't have one, get one. Having a formal policy means that credit management can follow a system and a process, rather than simply relying on information in somebody's head. The policy should include details of the credit management role and responsibilities. It will include what standard credit terms are and how exceptions are handled. It should also set out follow-up procedures in detail and give scripting both for email and phone follow-ups. It will have instructions for when stop credit is to be enforced and how the policy on bad debts and conditions for sending to external collection. In short, your policy should include all the details and instructions required for someone to succeed in that very important creditor management role. So the test of a good policy is pretty simple. Could a new team member take on the role today? No questions asked. So having a policy is a start. Actually using it is when you make real progress in improving your debtor position. Above all, you need consistency. Make sure statements are sent out on time, every time. Have regular, consistent follow-up. And as we all know, the squeaky wheel gets the oil. Debtor follow-up isn't something that your business needs to be apologetic about. And either is stop credit. Don't be afraid to enforce it. It may save you the headache of a large bad debt later on. It's your business, your rules. Finally, we'd strongly recommend regular debtor meetings. Get a couple of key people into a room, review the debtor's ledger, address any concerns, make some decisions and move on. These are great tools to keep on top of your debtors. And just finally, a bonus topic, we often get asked the question about whether to offer settlement discounts as a strategy to improve debtor days. Settlement discounts work for some businesses, but are a pretty expensive form of debt collection. Just think about this example. Let's say you offer a settlement discount of 3% for customers who pay within 14 days. Standard terms are 30 days end of month, which is effectively 45 days. So to get paid 1 month faster, you're offering a 3% discount. So your monthly interest rate is 3%, which means your annual interest rate is 36%. That's expensive finance. I'll now hand back over to Alistair for a moment.
Right, inventory. So if lazy cash is to be found on a balance sheet, and so often it is, the odds are that it will be in inventory. So there's always competing priorities when it comes to inventory management. No one likes back orders, of course, and missing out on a sale because something isn't in stock. But at the other end of the scale, overstocking and poor inventory control can mean huge chunks of cash are being tied up in inventory, and mostly unnecessarily. So how do you improve cash flow through better inventory management? And I'd just like to speak about 3 points, and that's accurate reporting, a regular review, and managing the numbers. So accurate reporting on inventory is essential. It seems like a pretty obvious point, but it's surprising how many businesses don't have a clear and accurate picture of their inventory and its performance. And so flying by the seat of your pants just won't cut it when you've got hundreds of thousands or perhaps millions tied up in your stock holdings. So make sure you have accurate reporting. Run regular inventory reports and actually take notice of what they're telling you so you can take action to improve your inventory days. Then regular review. To constantly optimise your inventory, regular review is critical. Of course, you should constantly monitor your inventory position on a regular basis, daily and weekly, but a regular formal review can be very valuable in gaining insights on how to improve your inventory. So even if it's once every quarter or even every 6 months, a good formal review is very valuable. And what it will tell you is key information about the performance of your inventory and allow you to make decisions to actually improve in many different areas right across your inventory. So it'll tell you which stock items are performing well and which ones aren't. It'll tell you the stock trends, so what is declining versus what is increasing. It'll allow you to forecast your stock holding better, allow you to identify stock lines that can be removed or perhaps consolidated, similar stock lines consolidated, and then slow-moving stock also that should be clear and can actually be turned into cash. And then finally, manage by the numbers. So no matter the size of the business, someone will have responsibility for the inventory management, whether it's you as a business owner or it's the procurement officer, or your warehouse manager or someone else, someone will have responsibility. And if inventory isn't managed properly, as we said, it can easily get out of hand and soak up valuable cash. But the point to make here is what gets measured gets managed. So manage by inventory days. Set some targets. Perhaps you can incentivise for improvements in these numbers. But whoever is responsible in your team for inventory management, they do need to be responsible for managing the numbers. Josh will now take over for the final section, the creditor conundrum.
Thanks, Alistair. So the final element of working capital is, of course, creditors, our favourite. If we look at how creditors impact the cash conversion cycle, it's obvious that paying your creditors slower will have a positive effect on your cash flow. But on the flip side, if you pay your creditors slowly, you also run the risk of harming your supplier relationships. So that's the real creditor conundrum. Do you pay fast or do you pay slow? The only real answer is that you have to get the balance right. Large businesses here in Australia tend to set their own rules when it comes to paying their creditors. And many of you on the call here would have experienced that, particularly those dealing with large construction companies. 90 or 120 days to pay is often standard practice. This is their way of using free credit extended by their suppliers rather than funds borrowed from the bank. Small and medium businesses don't find themselves in quite the same position and therefore cannot leverage creditors to the same extent. But that's not to say that cash flow improvements can't be found. The real secret is in communication. It is a mistake to regularly run creditors overdue without proper communication. How often do you speak to your key suppliers? How long since you tried to renegotiate better payment terms? Often suppliers will be prepared to extend trading terms. All it needs is just some communications. Just ask the questions. This is especially relevant for overseas suppliers, who in general are more prepared to extend their terms than local suppliers, particularly as your volume goes up. And with that, I'll hand over to Alistair.
Yeah, thanks, Josh. So we'll just recap quickly now on what we've learned today, and here's what we've covered. Obviously, we looked at where your profits have gone and how you can find them on the balance sheet. We've looked at the structure of your working capital, in particular the cash conversion cycle and what that means for your cash flow. We looked at the value of long-term improvements in that cycle versus just the short-term cash flow fixes. And then we've covered off on just a few strategies to improve your debtors and your inventory and your creditors. But if there's one lesson I think that I'd just like to hammer home today, and that is that there's so much cash that can be tied up in your working capital, and so know your numbers, analyse your working capital position, and then look at individual strategies that you can implement to actually improve each area of that working capital cycle. As a takeaway from this session, we'd recommend that you have a good look at the working capital in your own business, analyse the numbers, set some targets around cash flow recovery, and then implement strategies, as we said, in each area to improve that cash flow position. So to help you do that, we will make available to you our cash conversion cycle optimizer tool, and that will give you some insights into the working capital in your own business. Quick reminder, certainly appreciate your feedback, so please complete the form which pops up at the end of the session. We'll make a copy of today's presentation available to you. Once again, thanks for joining us today. We've certainly enjoyed having you along. We trust you have a successful December to cap off 2017 and look forward to catching up again in the new year. Until then, thank you once again and have a great day.